We all know that interest rates are a key factor for all of us, and many of the bank's financial products, whether on the deposit side or the credit side, are also seeing their rates rise. But what is the impact of the central bank on changing rates, and why do rates rise even when common sense suggests it's not the right time? Today we're speaking with Philippe Ledent, an expert economist at ING. Hello Philippe, good morning.
Hello everyone.
Now let's go step by step. This is quite a tricky subject. We're in a rising rate environment. Now, firstly, interest rates. What's really happening here?
Yeah, maybe first thing first. Let's give two basic principles. First, in an economy, in financial market, all interest rates are linked to each other. It's very simple to understand. You cannot borrow some money for a certain period of time with a certain risk and invest it for the same period of time with the same risk and gain some money. That's not possible. So this means that all interest rates will always be linked to each other. All financial products that you can have in financial market, there is a link between all interest rates.
So you're talking about the interest rate that perhaps I might pay back on a loan, but also the interest rate that I might receive on my deposits.
Yeah, so because principle number two, the banking sector is just a financial intermediary. So this means that the interest rate of the banking product are also linked to each other and linked to the interest rate on financial market indeed.
Now let's talk about the financial markets. I understand this is where rates are rising. Why is that?
Yeah, in fact, there are multiple reasons why interest rate can move in financial market. Basically, it's just a question of supply and demand of capital in the market. But fundamentally, there is another point. It is the influence of central banks. Central bank will play an important role in defining the evolution of interest rate in the market. Why? Because financial market, they want to finance the economy. That's their way of life. That's where they are there for that. But in order to finance the economy, they need to get some fresh money from the central bank. But the money coming from the central bank, it's not a gift. So the central bank will lend that money at a certain interest rate. So the rate at which financial market, or here I will include the banking sector, so the interest rate at which financial market or the banking sector will borrow that money to the central bank will have a very important influence on all interest rate in financial market and in the banking sector.
Okay, I get that. But do all the market rates react in the same way to these central bank rates?
No. First, it depends on the level of risk that can make big difference between different type of interest rate. And second, the time is very important. When the central bank lends money to financial market, to the economy, let's say it very simple, to the economy, it will do it through short-term operations. So this means that short-term interest rate, 3 months, 6 months, 1 year, they will react immediately to any move in the interest rate of the central bank. For long-term interest rate, that's a little bit more tricky. Because, so here I speak about an interest rate of 10 years, 15 years, 20 years. Just, Jim, imagine that when I borrow money for 10 years, the interest rate will be defined by the current short-term interest rate, that is, just remember, mainly defined by the central bank, but also by the anticipation that financial market do about what will be in the future short-term interest rate.
So you're trying to read the mind of the central banker, right?
Indeed. So you can read what the market think that the central bank will do in the future by looking at the evolution of a long-term interest rate. Indeed, long-term interest rate, and this can be very important for many companies. They have investment on the long-term perspective. A mortgage is also a long-term loan. And so all these long-term interest rates are defined by what the market anticipate about the future behavior of the central bank.
Now, there's been a lot of talk in the news about rising prices in the economy. What impact do these have on interest rates?
It is precisely the point. It is because we have such a high inflation for the moment. So inflation is the global evolution of consumer price, so the price of all what we consume. And it is on the rise in Europe, in the US, everywhere in the world. And not by 1 or 2%, by more than 8%. So there is a strong inflation for the time being. And basically, the central bank, it is responsible to lend some money, some fresh money to the economy, but it is also responsible to keep a stable inflation in the medium term. So this means that the current level of inflation is much too high for the central bank. So it needs to act. And how it will act? By increasing the interest rate at which it will lend money to the economy.
But the consequence of that is that for people who have loans, for example, that their repayments may be more.
Yeah, and that's precisely the point. That's precisely the goal of such a policy. Because by increasing the rate at which the central bank lend money to the financial market, so this will have an upward influence on all interest rate. So this means that what I pay for a credit for a mortgage or what I receive on my deposit, the interest rate will also increase. And this will change the behavior of consumers and companies in a way that will slow down inflation at the end.
So therefore, am I right in thinking since banks are increasing interest rates, they are anticipating moves in an upward direction later on this year, for example?
So basically, financial market, because it all has to do with financial market. Financial market are indeed anticipating an increase of interest rate in the coming quarters, let's say. So as they anticipate that, we already observe that long-term yields are increasing, and this has an influence on all long-term interest rate in the economy, including in the banking product.
But I thought there's one thing I'm not clear about here, and that is that if rising interest rates are designed to take the heat out of the economy, but isn't there a risk that it could take too much heat out of the economy and trigger a recession, for example?
Yeah, that illustrates that monetary policy management is not so easy. Because all what you want to do, in fact, by increasing your interest rate, you want to slow down consumer credit investment. You want people to save more and to consume less. These are all the channels through which a higher interest rate will slow down the global demand. Why? Because inflation is just the expression of a disequilibrium between a too strong global demand and a too weak global supply, I would say. And you want, as a central bank, you want to slow down the global demand. And it is precisely the same when you want to support the economy. You will decrease your interest rate in order to support the global demand. So, indeed, by moving the interest rate, the central bank wants to have an impact on the global demand in order to slow down or to push up, in this case it is to slow down, inflation. If you do that too much, the risk is indeed that, okay, you are happy because at the end you have less inflation, but you have also a too weak global demand, and even you could have, and this already happened in the past, you could have a recession that is induced by the action of the central bank. It's not easy. You need to find the just equilibrium. So this means also that you cannot increase your interest rate as much as you want, because at a certain moment, there is a risk of creating a recession. It's not so easy.
But it seems counterintuitive that right now to raise interest rates when the economy is still not really firing.
Yeah, certainly in the case of the euro area, because you observe that the economy is decelerating, but it is a little bit the lesser of two evils. On the one side, indeed, you could raise the question why moving interest rate now But on the other side, don't forget that inflation is very high. And inflation is also bad for the economy. It's bad for people. Of course, you could say, yeah, but if my income is indexed on inflation, I don't care. There is a rise of 8% in price, but my income increase also by 8%. I don't care. But that's not the case for everybody. And most of the people, they don't have an income in the euro area. They don't have an income that is indexed on inflation. So this means that for many companies, for many people, inflation, very high inflation, I'm not speaking here about a 2% inflation. I'm speaking here about above 8% inflation. This is bad for the people. This is bad for companies. And so you have also to think about the fact that the central bank needs the global well-being of all the people, and not only of the people that are reached or hit by an increasing interest rate. And the conclusion of that is that considering everything, considering all the negative consequences of having a too high inflation, it is important to act in terms of interest rate, even if the economy is not doing as well as we would like, but just to fight against that inflation that is bad for the people, bad for companies.
Thank you, Philippe, for those very complete explanations. So here we are at the end of our investigation. We're seeing major movements in financial product rates because market conditions are changing. And they're changing because we are anticipating rate hikes by central banks, hikes that have already begun just about everywhere. Now, these hikes are motivated by the desire to regain control of inflation, which it must be said is breaking all records. Is that a fair summary, Philippe?
Yes, it is.
Brilliant. That was Philippe Ledent, Senior Economist at ING. Thank you.
Thank you.
Don't hesitate to contact your ING team should you have any question or to discuss your personal situation. Find the right contact details on ing.lu/service.